Thank you all for coming. My name is Jack McCullough. I am one of the co-chairs of this event. I'm just curious why so many people know my cell phone number. I've gotten texts from no fewer than 40 people, and I don't actually know who, it comes in the number, but if you're not in my address book, I've gotten text. 3 people complained to me via text about the coffee, as though this was information that I needed to have immediately. I can't control the coffee, I'm sorry, but I was able to, I guess the room was a little cold and there were some audio problems in one of the panels. I was able to fix those. Did the best I could. Anyway, I want to turn this over to Carol Masser. Carol, this is your 5th time doing this.
We figured it out.
Yeah, I went back. This is the 5th time. She thought she signed up for 1 year, but Jeremy and I had a secret meeting. You signed up for life. She's actually great to work with. She does a thorough job. She's a lot of fun to do it. If you're interested in her bio, it is in the program guide, but she's one of the most well-respected and well-known anchors in all of business television. In fact, we had a dinner last night with a lot of the volunteers. Carol couldn't make it, but we just kind of one of those conversations, getting to know each other. And so it was like, who is the most famous person you ever met? And I actually said it was Carol.
So sad.
Yeah. and
I can say that.
Yeah. Then I actually changed my answer at the last minute. I went with Hulk Hogan. But at least it was
Good
a
company,
blonde. Yeah.
good company.
So you're number 2 to the Hulkster, baby. So anyway, I want to turn it over to Carol before I say anything really stupid. Anyway, like I said, it's going to be a great panel. Thank you for coming. And Carol, it's all
Jack,
yours.
thank you so much. And I have to say, 5 years, and I walked into the men's room today. You'd think I would know where the ladies' room was. So nobody was in there, so I'm very happy for that. Good afternoon, everybody. I am delighted to be back here at the summit. And there are so many things impacting today's executives and especially today's chief financial officers. It's so much more than just quarterly balance sheets and financial reports, although that's still very important. But if anything, the financial crisis really heightened how key the CFO job is today. I have to tell you, like Jeremy earlier, he said about how he Googled about the role of the CFO. I did the same thing. We all love Google. Deloitte says there are 4 faces of the CFO. 2 cover traditional roles. Steward, preserving the assets of the organization by minimizing risk and getting the books right. Check. Operator, running a tight finance operation that's efficient and effective. And then they said there are 2 newer roles. One is strategists, helping to shape overall strategy and direction, and then catalysts, instilling a financial approach and mind set throughout the organization to help other parts of the business perform better. And I think that is something we're going to hear a lot about from our panel. Let me introduce them. At the far end, we have Dennis Hickey, who became CFO of Colgate-Palmolive in January of 2011, but he's been at the company a long, long time. Next to him is Karen Ovelman. She is CFO of LyondellBasell. Did I say it correctly?
LyondellBasell.
Basell. I keep practicing and I get it wrong. She was named CFO in October of 2011, a well-known chemical company, and then some. Next to her is Brian Tierney, who became CFO at American Electric Power in October of 2009. Nice timing. And then you have next to me, or I have next to me, is David Herzog. He's the CFO of AIG, named in November of 2008. Also nice timing. But these guys have seen a lot, and we'll talk about that. So steward, operator, strategist, catalysts. Maybe simply put, how would you describe your job? Is it more strategic or operational? And Brian, let me kick it off with you.
Yes.
Yes.
Definitely is more strategic and more operational. There has to be a balance to those 2 things. You need to be able to work with the CEO and the board of directors and set a sense for where the company is going in the long term, where you're going to make your investments, how you're going to grow the company, and what the company is going to look like, not just at quarter end, but 5 years from now. And then to be able to achieve that strategic initiative, you need to be able to operate in a function that's consistent with that. And so you need to be able to have strategic alignment, not just with your board and your CEO, but all the way down to the line employees. And so that's partially teacher as well, and maybe that falls into the catalyst category.
And I think you said to me the CFO is in charge of nothing but responsible for everything.
Exactly.
Winning the lottery.
Exactly. So responsible for everything and in charge of nothing. When you speak outside to the company, you are probably the second most important spokesperson for the company after the chairman CEO, if those titles are together at the company. So Wall Street holds you completely responsible for what goes on in the company.
Right.
And then also inside the company, a lot of the employees hold you responsible for what goes on in the company, because you're responsible for where you make capital decisions, where you put O&M to work, and how you think about those things. But very little of the company might actually report to you. So I went from having 3,500 employees report to me when I was an operator to about 800 employees report to me now. So you need to have alignment and buy-in from the people that are the operators in the company.
Karen, talk to me about the balance between strategic and operational for CFO.
Yeah, I really don't think you can separate the two. From an operational perspective, there is an element of, what's your day job, what are the things you need to get done, as you go through earnings release every quarter, the monthly close, those types of things. From a strategic perspective, though, where the company is going, a lot of what we're doing on the financial side is there to enable that strategic approach. So, a lot of times you get questions in terms of what's your balance sheet look like, what's your metrics, what's your financial strategy. All of that really should be designed to support the corporate strategy. So the two, to me, you really can't separate them. I'm in the commodity business, and as we watch crude oil drop $18 over a couple of week period, that changes everything for us. So our long-range plans, how we look at things through a cycle. So whatever we're doing from a capital deployment perspective to support the corporate strategy, all of that has to be assessed through that financial lens. So I think the two, you really can't separate them. They go hand in hand. You've got to be completely engaged on the strategic side, not only commercially with the folks that you're working with in the business, but with the CEO and the board of directors.
Dennis, why don't you weigh in as well? And you guys
Yeah.
you have so many different products, so I'm assuming you've got to be
A lot of products,
coordinating
and
a lot
as
of
you
things.
said, I've had a lot of years with Colgate You Are Kind. The change has been, I think, very dramatic. You go back and you look at the history of the role of the CFO, where it was very much in the closing the books, getting things done, answering the question, how did we do? That very much evolved, I think, into how are we doing, but now more and more, it's how will we do? Looking more towards that strategic, prioritizing the investments, dealing with a lot of different people, getting people throughout the organization truly engaged in everything around how the numbers are delivered. Because again, the balance sheet, the P&L are just an output of a lot of things that are happening. And the more that you can get finance to be a collaborator in every area of the business, the more you can get finance and the CFO to be more of a contributor on the strategy. Because again, it's trying to translate that whole element of strategy is very much a part of delivering the business every single day. So they are inextricably linked.
David, in terms of your experience at AIG and kind of combining strategy and strategic and operational, I'm assuming they've gone hand in hand.
Well, they do now. Obviously, in 2008 through 2012, during the restructuring, it was probably more tilted towards transactional leadership and finding a path forward. But today, as a normal operating company, I spend an awful lot of time building and implementing frameworks. So as we think about capital allocation, capital deployment, we look through various lenses: growth, profitability, and risk, which are three of the key dimensions we focus on in terms of the capital allocation, resource allocation, and how we view our strategy. In our company, the CEO, along with the board, they own the strategy. I think it's very clear, and that as it should be, at least in our company. But we have a very collaborative group that vets those strategies, and so that there's clear buy-in. And it's a thorough vetting, but it is through those three lenses.
Take me back, though, to October 2008 when you became CFO of AIG. What was the job like then? You all want to know. I know this, and I want to know.
It was nothing to it. It was, well, I've often said I did survive. There was not a long line of people out the door volunteering to be the CFO.
Straw.
Yeah, I guess I didn't show up to a meeting or something and got appointed CFO. But listen, it was I mean, it was chaos.
Everybody.
It wasn't just in those of us in the financial sector. The markets were in free fall, and the markets weren't working, the liquidity wasn't working, and those environmental aspects had profound effects on our company. And I found myself in the crosshairs of it. And in 2008, after the helping hand from the Federal Reserve, we immediately turned our focus to, okay, now what do you do? How do you move forward? We could spend all day long agonizing about the past, but the past is the past.
But you had an infrastructure that was underinvested in, right? That
Well,
you really had to deal with.
it was, and we had started down that journey a couple of years prior to that, in terms of the financial infrastructure and other parts of the firm. But the key in 2008 was focus on the things that are going to make a difference. You have to. There were tons of things to work on, thousands of things that you could have spent your time on. But you had to focus on and prioritize what are the areas that are the most dangerous and critical that we have to get fixed, which is what led to some of the structures we put in place to deal with it. And so it was really a matter of trying to stay calm. Somebody has to be calm, and I tried to stay calm. And focus on the things that make a difference. And we put some things in place to deal with those, and it enabled us to move forward.
Talking about moving forward, Brian, you were CFO when a new CEO came in earlier this year. What was that like? Because that's a new step forward for a company, a different CEO, but what does it mean for the CFO?
It was a pretty seamless transition, but I think key to a CFO's survival is making sure you get along well with the CEO. And so
It sounds so easy, but
it does sound so easy. But they were clearly different people. I knew both of them. I had the opportunity to work with the new CEO on strategy for some period of time before the transition happened.
Right.
So we were thinking along the same lines. I'll tell you an anecdote that happened. Shortly after he was named CEO, we had an analyst in with a group of investors. And I sat down and met with them, and they asked me all their questions about the company, where we're going, how we're moving forward. And then the CEO came in and sat down next to me, and they started asking me the exact same questions. Sweat was pouring down it was as if he had listened to what I said or I had listened to what he said. It was very seamless, and the answers were the same. We're on the same page, and that to me is the key. The CFO needs to make sure he's on the same page as the CEO. And you can get there by having disagreements behind closed doors, by exchanging ideas behind closed doors, but at the end of the day, you need to make sure that you're on the same page.
safe to say if you hadn't been on the same page, you would have been out?
I think that's always the case with the CFO. I joke to our CEO that in the CEO playbook, when things go wrong, step one is fire the CFO.
Nice. Karen, you're getting ready for a new CEO.
I was going to say, that's very good advice right there.
Early 2015, right?
Right. So our CEO just resigned. And so the supervisory board right now is actively recruiting and exploring the possibilities for who the next CEO will be. So I appreciate that insight, because I may need to think that one through a little bit more.
What goes through your mind, though?
Well, this has been a company that it went through. It's really a new company, so to speak, because it did go through bankruptcy. So I came in and a new management team right after the bankruptcy, and we've been very focused operationally in terms of just getting things, infrastructure put in place, new commercial contracts, reducing costs, getting people in the right place, doing the right jobs. So very, very focused on that operational excellence. And now that we've kind of gotten through that, it's as we go through the next journey and where we're going as a company, we've had great returns to our shareholders. Our stock price has gone from 17 up through the hundreds, and everybody's very happy with that, but it's always that's great, that was yesterday, what are you going to do for us going forward? And so that's really the big kind of challenge that we have is, the new type of CEO that comes in, where the focus will be, how operational, how more strategic, and so how I align with that CEO, I think, will become very important.
But talk about when you got to the company, first of all, I think you had to build a lot of financial structures there, but you also said you had to deal with a culture and employees who had seen a lot of leaders come in. I think they called themselves the Weebies.
Yeah, so that was interesting. So the culturally was probably my biggest challenge. So I spent a good dozen years working with private equity and would go into smaller companies and really just have an opportunity to kind of go ahead and rehaul those companies, fix them up and get them ready to take them public. And so there were smaller companies to start with that grew into larger companies. But coming into this organization, it was a very large company. I think I said it this morning. I was meeting with some folks that said they worked with startups, and I said, yeah, me too, but it's a $50 billion startup, but a startup nonetheless. So we had to put in all that new infrastructure. And the thing that I probably underestimated the most, because when I was working with the PE, you kind of had control over it, was the culture. People were very much set in their ways. They'd seen a lot of leadership come through pre-bankruptcy, during the bankruptcy, post-bankruptcy, and they've heard a lot of the same stories. They understood that they needed the infrastructure, they needed global processes, they needed to doing things differently, but they all had their jobs, job security, and their Excel spreadsheets. Yeah, someone referred to them as weebies, and I said, well, what's a weebie? And they said, it's weebie here long after you're gone. So that was the big challenge, was getting a few good wins in and starting to convert that culture. And once you got the momentum, we did bring in some fresh faces, but we really did rely on a lot of the legacy folks because there was just great institutional knowledge there. But yeah, culturally, I think that was probably our biggest challenge.
Dennis, you've been at Colgate-Palmolive, I said earlier, a long time, and you call yourself, I think, the oldest millennial at the company.
Right.
And knowing millennials, I don't know how we feel about that.
Yeah, sorry about that.
But how has the financial responsibilities changed at Colgate-Palmolive for you?
Yeah, I think that the change, and again, I've been with Colgate since the late 70s, so 37 years. So, as I've been already told by a number of people, I wasn't even born yet. So the change, though, has been dramatic from a finance standpoint. When I joined, the finance people were generally accountants. They came in, they closed the books. Closing the books would take better part of a month. By the time you got the data, it was already outdated, and what are you going to do with it? And it's evolved to where finance people are more embedded in every aspect of the business. I'll think back to a time in the early 90s when I was working in our North American operations and wanted to put a finance person to work with our sales organization. And I said to the VP of sales, and I'm very excited about this, and I'm saying, I'm going to give you financial support to help your team move forward. And he turned, he looked at me a little bit, and he said, why don't you trust us? I said, it's not about trust. We're talking about return on investment. We're talking about how we get things better and how we get finance people to work as a part of the team. So immediately as that person gets in there, and this was a start, it was very much around a control and keeping track of numbers. But as people started to see the value that could be brought, we started seeing more of these people actually going in as part of an account call with an account like a Walmart, and really talking with the buyers and having an understanding of the objectives we had with the buyers' objectives. And really it all comes back to numbers. And a lot of this is getting the rest of the organization better understanding how those numbers come about. So lo and behold, we started getting more requests for finance people to go work with operations. Started out with sales, went into manufacturing, supply chain, into the procurement organization. So again, that finance group that started out as closing the books, being as they were affectionately called the green eye shade people, the weebies probably, they have now evolved to where they're spending much more of their time working in different aspects of the business. And candidly, I can't handle all the requests that we get for finance people.
How do you then pick and choose?
It winds up being who is ready for it. I mean, and who is willing to commit a person and use them appropriately. So what is the job specification? What are they trying to do? Is this just an extra pair of hands that's going to be doing copies or running spreadsheets? Or are these people that are going to truly be adding value? And, again, we're in, 80 countries around the world with operations. So does that local subsidiary have the people that are ready to fulfill some of those roles? And if not, how do we get them ready? How do we train them?
Right.
How do we get them the development in order to be ready? Because, again, these are meeting the needs, the future needs of the business. And back to the millennial comment of how do you address some of this also through technology enablement. So again, it's not so much the people, it's also having the technology and training those counterparts, whether they're in customer development or whether they're in the supply chain, to better use that for they themselves to be able to assess how the business is doing.
Well, and that's a great area to go into because I know that there was a discussion earlier about big data and analytics and really harnessing that. David, let me ask you, the financial area, there's so much data and trying to figure out how to best implement that and use it so that it's productive for the company, profitable for the company. What do you do?
Well, in the area of big data or just data analytics, we have enormous amounts of data about ourselves, about the market, about the risks that we insure. And I guess it was in 2012 when we had taken a fresh look at some of our reserves and ended up strengthening reserves in a pretty big way. It was absolutely the right thing to do, and it was the right judgment. But coming out of that, we asked ourselves a pretty simple question. We said it's one thing to, we look at judgments and they need to stand the test of time, both ourselves and all the people that second, third, fourth guess things we do, and that's all terrific. But we undertook a body of work that we call structural drivers. So it was trying to understand why. What was causing, whether it was loss cost trends or utilization or frequency or severity in terms of some of the risks that we were underlying. And it really got back to, now how do we then harness the data that we have available to us, and how do we avail ourselves of data that we don't generate ourselves, but is available to how do we then utilize that to not only understand the drivers and why now, but also feedback into the business in terms of how we price, how we do risk selection, how we do claims management, and more importantly then how we take those learnings to help our clients and our customers and our policyholders. How do we help them reduce their loss costs, make their plants and their operations safer, make their people safer. So we've taken what innocently started in an actuarial study to transform into, and now we take that and there's a regular feedback loop into the business with the business, the underwriters, and the marketing people. So we've made the most out of the need to get a better understanding.
When I think of data too, I think of cybersecurity in an area. Karen, that I think you had mentioned to me that's a pretty big area for you guys.
Yeah, you hear a lot about it in terms of large retail organizations. It also, from a manufacturing perspective, on the plant floor, it becomes a real security issue for us. And having that kind of emphasis around that is very, very important. Of course, we want to protect our data, all of that, but it also is very important for us to protect our facilities and the people working in those facilities. So I think with all of the new technology coming, I think it's just going to become more and more challenging. When we look at it from a risk management perspective, we believe we're doing a lot of the right things. We've got some great people in-house. That's all they do. They live for this stuff. And so we get a lot of confidence around that. But from a gross risk perspective, I think it's going to continue to come at us very, very quickly. They're getting smarter and better at it every single day. So that's an area for which I think the CFO plays a big role. I don't think you need to know everything from a technical expertise in that area, but you really do need to champion it throughout your organization. We have, all the way up through our supervisory board, the individual that's in charge of, all of the cybersecurity, all of those things around our IT systems, has been in front of our board several times already. We haven't had any unique issues. However, we really want them to understand how important it is, and I think that also sets a tone throughout the organization. That's where the CFO and the finance organization comes in place in terms of really putting the platform for that type of focus in the company.
And Dennis, you're the chief risk officer, aren't
Correct.
you, also at your company?
Correct. And candidly, I mean, the whole area of cyber is right up there. I don't think there's a board meeting that goes by where there isn't some discussion about that, and getting people to have a complete understanding of what cybersecurity is all about has been a bit of a challenge. As being the chief risk officer, we have an enterprise-wide or an ERM steering committee, enterprise risk management steering committee, and it's actually chaired by our chairman. It was interesting. When we would do it at a lower level, you wouldn't get full participation. As soon as he says we're having a meeting, everyone shows up. No surprise.
It's funny how that works.
And it's very interesting, as you've gotten people around the table from different disciplines who thought risk only related to them, and you start to talk about end-to-end processes and how people across different areas are involved in different things, you start to get a better understanding of how significant cybersecurity can be and the role it can have throughout your organization.
Brian, I gotta bring you in because as a utility, I'm thinking you guys think about this a lot, the various risks that are out there.
We think about it a whole lot, and some of the themes that Karen and Dennis were talking about are really sort of the blurring of the lines between cybersecurity and physical security. So we do everything we can to keep the electric grid safe from a cybersecurity standpoint, and then out in California, someone's shooting with a rifle at a substation and trying to take it out. So what's the line between protecting it from a cyber standpoint and protecting it from a physical standpoint?
How do you, because this panel is supposed to be about the future forward, how do you plan for what might be the risk in 2 years from now, 3 years from now? How do you plan for protecting the company?
So you need to do all the things prudently that you can from the actions that you've seen taken out there in public. So you need to make sure that you're hiring the best people in cybersecurity and physical security, that you're evaluating your circumstance against the circumstances that you've seen out there. But you also have to have a little bit of creativity.
Right.
And that, I look at this Ebola scare that just happened here in the United States. We thought we were pretty good about infectious diseases, and maybe we were good at protecting infectious diseases from the AIDS level risk. We weren't nearly prepared for what we needed to from an Ebola standpoint. So you can't prepare for the last crisis. You need to be resilient in the next one, and you need to have a little creativity and thinking about how you're going to recover from the next one, because the last one's already happened. It may or may not happen again.
Right. You said something that stuck with me. You said if you think you're planning for another 9/11 event, that's not the way to approach it.
That's exactly right.
David, what about though at AIG? I think, how do you guys balance risk-taking from a strategy with also going after growth and performance? How do you help make those decisions?
Well, as I said earlier, we have a pretty well-established framework for looking at initiatives or strategies through the need for growth, the need for controlling risk, and the need for profitability. And we have a series or a set of value-based metrics, whether that's the value of new business or risk-adjusted profitability at a major product line or major country or region. And it's really through that lens. We have, over the course of the last several years, remade risk management inside our firm, and we think about it through, I'll call it lines of defense. So oftentimes, finance, whether it's the finance or the actuarial team, we're the first line of defense. And we think of ERM as the second line of defense, and then audit as a third line, internal audit as a third line. And so that's how we look through those various perspectives.
But is it tough, kind of balancing risk?
Well, we
and
have the
growth?
risk. It is and it isn't. I mean, the fact that we have risk appetite statements, we measure our consumption of risk at the various levels. We look for concentration, because you go back and and we've learned from the events of 2008. Shame on us if we didn't, but it.
And I guess what I'm going after is I think after the crisis, a lot of things swung the other way, and understandably so for all companies, not just financial companies. Everybody learned a big lesson, and I'm curious how much of that is still an impact where it's keeping companies, not just AIG, from kind of holding back on taking on too much risk.
Well, I don't think it. I think it's a healthy tension. I mean, and that's part of. I think that's part of the role of finance is creating healthy tension, because that's out of that tension usually comes good decisions, and our CEO likes to think and challenge us on the boundaries. Not that you do something on the boundary, but it's a way to unlock how we think about boundary conditions, and it's been a very healthy and very useful framework for us. And there's good discussion because we have a fair amount of transparency into the various lines of business, how we allocate capital, and where the growth opportunities are. And again, in our firm, the risk management group, there was a time historically where it was a department and it rolled up through the CEO or the CFO, and we looked at that and said, that may not be the best governance for our company. Other companies, it works just fine, but for our company, it needs to be an independent part of the thought leadership of the company and look at things in an independent way that is, again, provides an element of the healthy tension in the room. For us, that's worked reasonably well.
Well, Dennis, let me ask you, as Chief Risk Officer, do you feel like you can separate out things and be independent?
Yeah, and again, it doesn't just come back to me. I think it's getting the right people around the table. So to the extent you can get that group of people who are all largely direct reports to the CEO around the table and understanding their role in managing risk and taking the appropriate decisions, asking the right questions.
Right.
Because it really does come back to being willing to ask the right questions, to challenge one another, to know where you are today and know where you're hoping to be in the future, and saying, are you really ready and enabled to get there? So I think no matter where it reports, it can work, but it has to work with everyone, working collaboratively and taking their share of the load. Right. If it were reported just to me and everything was going to be, well, you're responsible for it, it's not going to work. It's just not going to work.
Karen, how do you balance risk and opportunities while kind of planning for growth for years to come at the company?
So from an enterprise risk management perspective in our organization, we're a commodity manufacturer. So first and foremost, it's about operations. If we're not running our plants safely, then we can't capture the market. So that's a big part of everything that we do. We're a very low-cost operational excellence, and keeping our people safe, product safety, all of that becomes first and foremost. So for us, we kind of categorize that as kind of a risk to performance. And then the other element is risk to value, which is from an overall shareholder perspective. Obviously from an operations, that supports all of that risk to value, but how do we have those returns to our shareholders today, in the near term, and over the longer term? So those are the types of things when we're looking at growth. We spent a lot of time, fortunate or unfortunate, coming out of bankruptcy. We were lucky to have opportunities to grow with our own internal, kind of brownfield type, debottlenecking type projects. So organic projects within the organization that we were able to do very quickly, limited use of cash, and get returns very quickly on those projects. So a lot of opportunities because those things weren't being done when the company didn't have a lot of money. And so when they came out of bankruptcy, you've all heard about fracking and natural gas advantage here in the U.S. Well, we're big beneficiaries of that. So we came out of bankruptcy and essentially got hit with a tidal wave of good fortune with the ethane advantage here in North America. And as a result, we've been able to grow organically with, I would say a lot less risk, and then some, long-term, very expensive lead time projects that come out, 5 years from now. So a lot of our projects are coming on 1 or 2 years in advance. So it's those types of analysis that we have to go through, doing the day job, all of the risk to performance, operations, that's the thing you can't lose sight of. We do that all the time. It's part of our DNA. We're all risk owners. You know, my organization's responsible for making sure the framework's there, but we don't own all those risks. And everybody knows who owns the risks, and they manage those every day. But then on top of that, from a strategic perspective, constantly have to say, okay, near term, longer term, what's the risk to value, and how can we enable the growth for the company?
Brian, I want to focus a little bit more on the CEO and CFO relationship and how important that is, especially in an environment where executives, it can change a lot. And so it's sometimes tougher to have continuity. But talk to me about the importance of you and your CEO being aligned.
I just, as two very senior leaders of the company, one, the CEO setting vision and overall direction for the company, and the CFO being responsible for either the risk or the balance sheet or the allocation of capital to make that happen. If you're not on the same page, it just doesn't work. And
the company will grow going forward.
The company won't grow. It won't manage its risks properly. The messaging to investors and employees will be different. It just doesn't work. And you know, I was only half jokingly saying that if the CEO and CFO don't get along, you fire the CFO. That's the CEO's job, is to make sure that he has the person there
Right.
that is going to help enable both strategically where the company's going, and then even in the short term, make the dollars available to make it happen.
But David, that may also mean in some cases you're telling the CEO sometimes what they want to hear and sometimes what they don't want to hear. And is that your responsibility?
The short answer to that is yes, and picking up on Brian, your comments, I think the relationship to work, to be successful long term, has to be founded in trust and mutual respect. And if it's not, you're going to have a problem.
What if you
Because you're exactly to your point. Because sometimes you have to be able to stand up and tell CEO or tell other members of the leadership team what they need to hear, and it may not be what they want to hear, but if you can articulate the issue and the rationale, they'll appreciate it's what they need to hear. And I think that has to be the ultimate, the ultimate long-term test is are you able to provide that kind of leadership and that balance in a leadership team, because it does take a team. Everybody has very different perspectives, and I was fortunate that I actually was able to help recruit the gentleman who's now our CEO back in 2009 to join the company. Obviously didn't join the company as the CEO then, but I was recruiting him to be my then boss. And so, which adds a little interesting dynamic to it. But listen, there was a lot going on, and we needed all the smart, energetic people that bought into where we were going and what we were doing. And so, our relationship is founded, goes back to those roots when, if you can stand up and actually help recruit the person who's going to be your boss, that's
pretty powerful.
Our roots go back not very long, but they're pretty deep. And that makes a big difference.
Dennis, you got big, long roots with your CEO as well.
Exactly. Yeah. As much as I'm 37, he's 38. and really, for about 20 of those years, we've worked together in one responsibility or another. But the one thing that I've noticed in the relationship of CEO and CFO, it does have to be, exactly as been said, from a trust standpoint. There's an expectation that you challenge one another. And it's interesting, how a CEO and a CFO operate together is seen by the entire company, and it somewhat sets the tone for how the rest of the company will operate. So if you have an environment where people are willing to challenge one another and talk about issues, and I'll come back to that in just a second, you're going to have a much healthier organization. You'll be able to drill down into that whole thing of the drivers, the root cause of things. Because I can remember years back where we would have budget reviews, and November is typically our budget season, and we'd have it in a conference room in New York, and I swore over the top of the door, it said, "Good news only." because you would get deluged with PowerPoint presentations of just a data dump over the course of a month of how different operations do around the world, but you didn't really get to the issues. Today, we're much more of an issues-focused organization. What used to be 2-day meetings are now half-day meetings. But it's much more of a focused group,
Why
really
is
trying
that?
to drive.
Why have you seen that evolution? Out of necessity? Or?
I think it's really out of the effective use of people's time and resources.
Yeah.
People say, well, the low-hanging fruit isn't there any longer. The low-hanging fruit is there. You just have to look a little harder. And I think the whole thing of coming back to the discussion that was talked about this morning of asking the right questions, that is what it's all about. It's really, it's what we learned in kindergarten. Ask the question why and keep asking the question why until you get down to that root cause of what's going on. And I think the more we're able to do that, because we're all stretched. The word focus came up a number of times. We have to focus, we have to prioritize. And the best way to do that is to get your organization tackling the issues. But the big thing is get them comfortable. Because after you come from an environment of good news only, getting a person in the room and say, we want to talk about your issues, that was, if a person previously had brought an issue, they'd be viewed as a failure. No, you're not supposed to have issues. You're supposed to have everything thought out, and everything is supposed to be
So
perfect
ask those
world.
uncomfortable questions, which is what we heard this morning.
Very much so.
Karen, your CEO is an operations guy, I think you had told me, but he appreciates that whole financial side of the equation.
Yeah, so he's very operational and commercially focused, but has tremendous breadth, I think, across all functions within the organization, and a true appreciation for the finance focus, all of the back office type areas or support services within the organization. So, which is, I think, key. When you're talking about having good controls, processes, as a financial organization, you want to have some leverage there. And if you have a CEO that understands and appreciates the importance of all of that, it just makes everything so much easier. It also allows, I think, for the other executives in the organization or folks that are really focused on operations to develop a true appreciation of it as well. I think once you start putting up those walls and you let the walls down and you let finance folks in to kind of help in terms of providing value-add information, putting in good global processes, standardization, you start to see the benefits. And so I think if you have a CEO that really has that level of appreciation, it does make it much easier for us.
I want to talk a little bit about activist investors, because it's been a pretty busy year, as you all know, whether it's Carl Icahn and Apple or Bill Ackman or Nelson Peltz. And it can be good for a company, it can be good for a company's stock price and strategy. David, you mentioned that you spend a lot of time engaged with your investors. You pay equal attention, whether it's the big guys, the small guys, the longs, the shorts, the passive, the activist investors. Talk to us about kind of managing that side of your job, while keeping the company going forward.
I think you captured the essence of it.
Sorry, I took good
no.
notes.
You did. You're a good listener. We do pay a lot of attention to our stakeholders, and that's, again, I look through that lens. And so whether that's all of our shareholders in the evolution of our shareholder base, we have a terrific investor relations group. It's led by Liz Werner, who's here with me today. She works us to death in terms of outreach, and we spend a lot of time and energy, and I in particular spend a lot of time meeting with investors all over the world. We go on non-deal roadshows, both for equity and for fixed income in all parts of the world, because it's a way to stay in tune with the people that are voting with their money.
Is it a bigger part of the job than it was pre-crisis?
Well,
And not
I
just
was
for AIG specifically,
yeah. I
but
mean,
in
for me,
general.
I was the controller pre-crisis, and I spent very little time with investors back then. I just did. That was part of my role, and wasn't part of my role. But we, coming out of the crisis, we had, I don't know, some $50 billion worth of stock to sell. So
I know we reported on it.
I'm glad to say we did, and we're able to get that done. But you can't do that by, just mailing it in from New York or wherever your home office is. You have to. We worked that part of the process really hard, and we've just continued it. We've carried on the momentum. We're still very active, and we spend time with all of our shareholders, activists or otherwise, to try to maintain an open dialogue and understand what their thoughts and priorities and perspectives are, because they're an important stakeholder. No, there's no question about it.
Brian, when it comes to activists, from your perspective, you want to be what? Proactive. You want to be out there, out in front.
Very much so. So I'm the CFO of an electric utility, and for the most part, activists have not been very engaged in the utility space, and that's okay with us.
Don't tweet that out, please.
But I've spoken with some folks who have been subject to activist shareholders, and their counsel to me was be proactive. So when we talk to our board about how an activist would view us, and it comes down to a few things. Activists are attracted by underperformance, and then when they come in, they want to look at governance, they want to look at strategy, and they want to look at what you do with your balance sheet and how are you returning capital or not to your shareholders. So certainly make sure you're not underperforming. Make sure you have a strategy that is well thought out, challenged in the board and senior management in an open dialogue, and then explained very clearly to your investors so they know what they're investing in and can see how you intend to grow the company over time. And then in terms of the balance sheet, for us, that means weighing growth capital, how do you reinvest in the business, with dividend policy, and making sure that you're striking the right balance for what investors in your industry are looking for. So I really think viewing the company through the eyes of an activist shareholder is a valuable exercise for most companies to do.
Karen, I'm thinking as Brian's talking, are you saying, well, we've got performance, we're a pure play, so we don't have too much to worry about when it comes to activists? Do you kind of feel that way?
You haven't had a lot of activism in your space, but there's a lot in our space. Okay, so Dow, DuPont, big companies, been around forever. I never would have anticipated to see, very active activists in those big companies. That's what's changed over the last few years. When it comes to our company, we have had some great results over the last few years, and so are we concerned about it? I wouldn't say concerned, but I think we acknowledge that all of our stakeholders have different views and come from their investment decisions from different directions. And as a company, we've evolved, right? So do you have a lot of hedge funds in there? Are they fixed income? Are they long only? Are they growth? And every investor may be looking at it from a short-term versus a longer-term perspective. Taking into consideration all of those inputs, I think, is very important. I think when we're out meeting with investors, sometimes we forget to ask them questions. What do they think about our strategy? Is it transparent? Do they know where we're going? Are we saying what we're going to do and then doing what we said? So I think all of that comes into play. We also look at our shareholders, I think, no differently than Dow and DuPont would look at their shareholders in terms of getting their input, in terms of how to best strategize with them and where to take the company. We have a lot of cash on our balance sheets in our industry right now. I think there's more cash sitting on most S&P 500 right now, and there's a lot of money going back into dividends and buybacks, which is great. Shareholders appreciate all that, but they're also looking for growth over the longer term. So it's challenging. Even though we've had a great history, again, I said it before, that was yesterday, so what are you going to do for me next week? And we've got to continue to be on top of that and continue to embrace and engage with all of those shareholders.
It's kind of always there.
Yep.
The potential for it.
And I don't necessarily think it's an unhealthy thing at all.
Yeah.
I think it's actually a very healthy thing because when you look at some of the activism that's taking place, they're trying to extract value. And we may be concerned that it's for the short term, but I think some of it is actually over the longer term and what's the right structure for that company.
Dennis, I have to tell you, Bloomberg News wrote a story or two on how in the year of the mega merger, even a $60 billion toothpaste giant isn't too big to wind up on someone's shopping list. And they cited analysts who are saying Colgate is a desirable target. So how much of what you do is keeping, making sure your investors are happy, talking with your IR team, keeping an eye on potential activist investors. And I did check the holdings, and Bill Ackman, Carl Icahn, they're not at the top of the list, at least not
Good.
yet.
Isn't this the time we cut the Q&A?
Exactly. Not yet.
Not yet, okay.
Almost.
Colgate is a $60+ billion company, and yes, there was stuff in the news. And there always seems to be it seems to go at intervals of every 18 months, something will pop up of could we be a target. I think it's one of those things you can't control if you're a target. All you can control is you run your business the best way you can. You ensure that you're delivering shareholder value every day. And generally, if you're doing that, your stock price is pretty high.
Yeah.
So to acquire a company like a Colgate would really take the largest consumer products acquisition in the history of the market. And so it's not something we get concerned about. But I think the whole thing of the same thing with activists. It used to be you think, no, we're immune to that. No one's immune. I think the whole thing of being concerned, I don't know that we're concerned about it, but we are aware of them. We are aware of what people are focusing in on, and we try to ensure that people do get the communications, as everyone has said. Clear, transparent communications. If you have a strategy, execute the strategy. We try to keep our responses to analysts as fact-based as possible. It says, we're executing, this is what we said we're going to do, this is what we're doing, this is how we're doing. And I think with that, companies that perform continually, it's hard to say, and again, I think the M&A discussion that was held in this room previously, that there's a lot of money out there. And people can spend it in a lot of different ways, and some people are out there rushing to make acquisitions. It's not something that I think we're worried about. It's not something that is on the front burner, so to speak. But it's just something that, from our standpoint, it's manage the business day in and day out as best you can, and deliver peer-leading results.
Safe to say you're spending more time, though, on activists, or the thinking of it than you used to?
It's an agenda item where it wouldn't have been before. So it's an item I'll spend time with outside advisors or with our legal group, and we'll have discussions with different board members at times. We'll talk about it with our CEO. We'll talk about it with different people who may sit on boards of other companies to get a better sense as to what are they doing, what are they hearing, what's the sense. If activists are getting involved, what are they probing at, what are they trying to get at. But one of the things that we've tried to get across too in our communications is we have a strategy, and the strategy is there from a long-term perspective. We've been in business since 1806. We continue, now pretty well. So, Thomas Jefferson was president back then. So a lot has changed, since that point in time. But again, the whole thing of focusing on your results, delivering the business day in and day out, I think that protects companies pretty well.
I have more questions, but I think Dennis had a good idea. If anybody in the audience, there's so many of you, and we've got this great panel. If anybody has a question, they'd like to pose it to the panel or pose it to anyone in particular. Really? All right. Well, I have some more questions because I want to ask you about in this day and age of communications. I want to talk a little bit about communications, but quarterly earnings. I think, Brian, you said it's the cross you have to bear. How do you, and I say this every time because I do sometimes fault financial media because we do the quarterly earnings reports. We obsess about the numbers. They missed by a penny. They beat by a penny. And I think companies wouldn't do the great spending they do and build the companies to do if everybody was just quarter-to-quarter focused. You have to be longer-term focused. So talk to me about managing those quarterly earnings that are going to get a lot of attention, but you got to manage for the long term and make those decisions that will grow.
Yeah, the work is a cross you have to bear, but it's a great opportunity as well. And
How so?
For a CFO, people look to you not just to put the numbers out there. Anyone can read the numbers. What do the numbers mean? What's the story behind what's going on with your business? And in business, right, finance and numbers tell the story. But there's something going on in the underlying fundamentals of your business that's the story behind what numbers you put out on a quarterly basis. Right. And that's what investors look for the CFO and CEO to explain on an earnings call. And so it's an opportunity to give an update on how you're doing against your strategy. What things are working well, what things are not working well. What are you doing as a management team to address those issues? And it really is a great opportunity to have everyone together that needs to hear that story, to have them in one place with ears listening and have the opportunity to tell the story, and then to respond to questions from what's on their mind and how do they react to that.
Do you feel like the questions are good questions usually?
I do. I think I do. It's people who are either analysts or investors who want to know something about the story that you just told. And so if you maybe didn't tell it the way you wanted to, or if someone has a question, you can bet a number of other folks have the same question. And it's an opportunity for you to clarify or redirect something that may not have been as clear as you might have liked in your prepared remarks.
David, talk to me about those quarterly earnings report, and I think about, how maybe the process has changed at AIG, right? As you've gone from a company that owed a lot of money to the government to not owing the government and stuff. How has that changed? And under different CEOs.
Yeah, there was a time in 2008 and 9 where we didn't have earnings calls. I could, honestly, back then, I could pick up the phone and make 2 phone calls and talk to 98% of our investors.
Uncle Sam, how you doing today?
Well, it's just, I hate to...
Or you
I
can
just,
call me, the
it
taxpayer.
happens to be the truth. So 2 phone calls and check off.
What was that like, though?
Well, we knew we were on a journey.
Yeah.
And again, it goes back to what good is going to come out of holding an earnings call when, again, 98% of the investors are represented by 2 stakeholders.
So are you glad that it's back to normal?
Yeah, it very much so. And I think, our shareholder base has gone through and is still going through a transformation. But again, when we had to sell the government's shares, again, we spent a lot of time doing outreach, non-deal roadshows, which turned into deal roadshows, and we did those almost every quarter. And we had investors who had very different horizons, some of which bought in 2000 and in 2000, I guess it was 12, and they're still with us. And there are others that bought and had a different holding period horizon, and they've come and gone. And I think it is an opportunity to update the investment community, both the people that own you, as well as the people who don't own you yet, to convey to them the journey that you're on, where are you at, what are your priorities, and what's the progress that you're making, and what are the priorities of the firm. So I think the calls are valuable because listen, our calls are 1 hour, and they're time for prepared remarks and about 7 to 10 questions, and that's it. And so it's not as much about the call as it is setting the stage for all of the aftermarket, after call, after release activity that we do. And it's the non-deal roadshows, it's the phone calls we have with both the analysts and the investors. On our call, it tends to be the sell-side analysts that cover us. And then in the aftermarket tends to be the investors. And that cadence and pattern seems to work reasonably well for us in a way to have the dialogue about where we are and where we're going.
Karen, when you first got to your firm, I think you said your company that it took you, about a month to close the books?
Yeah.
And it evolved.
Yes. Earnings release, it was, or even just any monthly close, was just a Herculean effort. It was a company that grew up with lots of mergers, acquisitions, and then, of course, went through the bankruptcy. So not a lot of financial integration through that process. So literally churning from 1 month to the next. And then on the outside, like I said, we were very fortunate in terms of the North American ethane advantage. And so we were very much evolving from the outside perspective. We were operationally excellent, safety statistics the best in the industry. We were now an investment grade company on the index. So all of those things look great as a fully evolved company. But on the inside, there was still a lot of work that needed to be done. I used to always liken it to my 17-year-old son at the time. He was a big, tall guy. he looked like a full-grown man. He shaved everything, but I can assure you I live with the boy, and there's still a lot of work that needs to be done before we can call that a fait accompli. So we were still working just tremendously within the organization, and so earnings release was just a huge burden and almost just consumed everybody. Once we got things automated and got the right global processes and standardization, we talked a lot about data this morning as well. We had a lot of data, but not a lot of information, not a lot of value-added analytics or any of that. So we've come a long way, and so now earnings release is much more constructive. Our numbers are done very, very quickly, and we have time to really, really work on more of the longer range planning, more of the global macro conditions that we're seeing. And on the calls now, they are very much focused more globally and in terms of macro commodities and long-term, basic supply-demand fundamentals versus, questioning where we are from a financial perspective.
And I'm just going to actually quote Dennis, because he said this on the phone to me. He said, well, they're a pain in the neck, but you're headed to, I think, an earnings meeting or something. I know we've got to wrap up, but I would like to just quickly get everybody's last thought on what should CFOs today be planning for tomorrow. And Dennis, why don't you kick that off?
No,
or
I
maybe,
think,
what should be the key question they're asking themselves?
no, I think the key thing for the CFOs from a future standpoint is really building collaboration throughout the organization. I think the more a CFO can engage the entire organization with a CEO that is of a like mindset, the more you can really make an organization strong from a long-term perspective. I think what we're looking at today is an environment where change is accelerated, so much, and it's as we saw this morning, it's only going up exponentially from a future standpoint. The ability to digest that, to focus and prioritize, and then to lead an organization. So I think it's important for the CFOs to step forward and be the leaders, be the communicators, get out in front, especially in front of your own organization, to really explain what is it going to take for the organization, not just to be successful today, but recognizing success is never final. How do you have an organization that is a continual high performer out into the future?
Karen, your thoughts in terms of today's CFOs and what they should be planning for tomorrow?
Yeah, I'll just build on that a little bit. I think the finance organization, led by the CFO, has a great opportunity to really pull together an entire organization. How you strategically look at where you're going as an organization, that underlying financial information, bringing together commercially, operationally, all of everybody's inputs into this. We sit in a great position to be able to do that. And it's about looking at things over the longer term. For me, it's looking at things through a cycle. And we all have macroeconomic cycles we have to look through as well. We can provide that platform that gives that information and the tools that we need, or the framework that our boards and the rest of our executive leadership team can have a good dialogue about where we're going strategically and what are the things we need to focus on. I think the CFO in that regard just plays a tremendous role, a value-add role for an organization.
Brian.
I think the CFO of the future needs to be engaged with all the constituencies that he or she has to serve. So being responsible for everything and in charge of nothing, people really do look for you to be a leader in the company. And you're not the ultimate leader, you're not the CEO or chairman, but you have influence there. You're not on the board of directors. You have influence there, and you should use that influence for the long-term good of the company. You need to be engaged with your bankers, you need to be engaged with your creditors, your investors, and ultimately you have to have some engagement as well with your customers, because that's where the money ultimately comes from. So all those people that don't report to you, that might not say yes to you like they might to the CEO or the chairman, you need to be engaged with trying to move the company forward in the right direction.
David, last thought.
Two very quick things. One, as I think about the role of the CFO, it's tone at the top, because you set the tone for not only the finance unit, but for the rest of the company, and so it's how we think about how we approach opportunities and challenges. And I think from a CFO standpoint, It's about trying to stay a step or two ahead and anticipate what's next. It's not about what did happen. We've got a lot of terrific people that figure out what did happen and even why, but it's about what's going to happen and to try to anticipate. And so it's looking forward, not looking back.
And on that note, we're going to leave it there. Thank you so much. Everybody, thank you.